Welcome back, everyone. This week, I want to talk about all the nonsense, garbage, contradictive information, and partial truths that you will discover upon the journey of investing. And as the title suggests, it's this type of material that we're covering today is why when I first started my investing journey, I just called it quits. And a quick summary of that is something along the lines of you discover what a PE ratio is. So then you go about trying to do a PE ratio calculation. You get the 10Ks, the 10Qs, and then you do the math. You get the share price, the earnings per share, find out what the PE ratio is. And then what you do is you try to confirm that with reputable sources and compare it and to validate that you're doing the work correctly. Well, as this screen shows, it infuriated me so bad. I wasn't aware of the disparity of reporting of PE ratios at the time. So all I knew is I seemingly did the math correctly, and yet these sources of information, whoever they might be, disconfirmed my conclusion, meaning that I was doing something wrong and I didn't know any better. So therefore, I, in my humble, naive state, thought I was doing something wrong. And this occurred time and time again, regardless of price to book or PE ratio or cash flow multiple or whatever it was, that I became so despondent and I suspect became and fell into a state of learned helplessness that no matter what I did, it didn't seem to make a significant difference and to get me to accurately conclude things. So, well, as I noted, it frustrated me so much that I said, well, this isn't for me, and I quit. Now, of course, obviously, I've come back to it. And today we're going to cover this PE multiple thing. We're going to cover information. I try to be transparent when providing you all with information, and oftentimes when it comes to getting information, you get a lot of information. The issue is that most of it, or a good deal of it, is wrong. And we'll cover definitions and examples of return on equity, return on assets, which is actually what prompted me making this video, was me reading an article about return on equity, and the contradiction or discontinuity within the article itself irritated me and reminded me and triggered me of these earlier days, and that's what led to this video. So anyway, with that out of the way, we're going to cover a lot and numerous examples that you yourself might come along, and to let you know that you're not alone and it's not going to stop. So PE ratio for Microsoft, a big time, one of the largest companies there is. You think tons of analyst coverage, you think things would be consistent. They're not. The disparity here is between 33.98 PE ratio, and I believe the lowest one is a 31.94 PE ratio. And then look at all these other ones: 33.62, 31.83, 33.84, 33.62, and on it goes. And these authority figures, let's just call these websites that, you think there would be continuity among them, but there isn't. Now, you could say they're within a ballpark, but you would think it'd be pretty simple to get the last 4 quarterly statements and then just do the math. The earnings per share times the share price, and then you get your PE ratio, and that's not at all the case. And then you have to factor in, is this diluted shares? Is it not diluted shares? What date? Maybe one of these updated it October 25th was the last update versus October 26th or 24th or a month ago. I came across this, which I don't honestly know what to make of it, but I want to point out first, they say the PE ratio is 44, but above they mention it's 31, and I honestly don't even know what to make of this, except that PE ratio is much higher than any of the others, so I'm not really sure what that's about. But here they say the PE ratio is a simple way to assess whether a stock is over or undervalued and is the most widely used valuation measure. Microsoft PE ratio as of October 26th, 2023 is 31.38. But here they have October 27th, one day later, and the PE ratio is 44.93. So you might say maybe Microsoft bought a whole bunch of shares, or the price radically moved. But here's the chart. It didn't. It's down 0.5% from one day to the next, assuming that they did it on the closing of aftermarket trading. So I don't even know. I don't even know what to make of this. And the disparity, you could say, what's 1 or 2 PE multiples? Well, that's on a widely covered, trillion-dollar company. It gets a lot worse the more illiquid the names go. And then sometimes you don't get any coverage at all. And I'm not really sure if these are manually inputted or some algorithm figures it out, because I don't understand why a lot of these names I play in only have partial coverage. You go to a website and it might show you some information, might show you price to cash flow, but it won't show you price to book or adjusted funds from operation or this or that. And I'm not really sure what to make of that. But here's TSQ, Town Square Media, a stock I own. And what I want to point out is the PE gap forward. One site reports a 25 times multiple for forward PE, and then the other one says 4.69. Now, if you notice, a lot of times when it says NM, it means not meaningful. And that's why the below image shows 7,445 times PE, because essentially when net income is a very minute portion of the company, the market cap, then you get really big numbers like that. And that's why companies that don't have any net income or negative net income don't have a price to earnings multiple, because they don't have any earnings. Earnings being defined by net income found on the income statement, which, as I've stressed time and time again, you must question the concepts in a statement as much as the statement itself. And the other thing to remember, where there's 2 other things, is you must keep constant your comparisons and control for variables, and things don't make sense until you look at them from a point of view in which they do make sense. If you take those 3 adages, aphorisms, insights, wisdom with you, then you'll really be able, well, hopefully, it will greatly aid you in getting farther in life than you alternatively would. Because my question is to this bottom image, is that gap or non-gap, the forward PE that is? Because it would be weird for the PE on the top, which is 7,445, which I would say is gap, so gap to be done for the PE, but then non-gap to be done for the forward PE, because that would explain perhaps quite the disparity between the forward PE estimates on the bottom image versus the forward PE estimates on the top image. But that internal inconsistency would be odd. So, and I'm not quite sure who comes up with these, analysts. So do they aggregate and then average the forward expected PE? Or like how do they come to conclusion? Like, okay, this is the concept. 25.33 PE gap forward and then 4.69 PE gap forward. That's the concept. That's what's being expressed. But then you have to question the concept as much as the concept itself, which is how did they determine the forward PE gap ratio? Because trailing 12 months PE gap is pretty, well, self-explanatory. Those numbers don't change. They're in the 10 Qs. And then it doesn't get any better with dividends. I don't know how many times I go to look up what a dividend on something is, and then you get different reportings. And then the top one is, this is of Town Square Media still, the top one says that the dividend yield is 6.87%. And then the bottom one says that the dividend yield is 9.16%. Now you'll notice they're both actually correct in this one, because the dividend yield, well, so yet again, you have to question the concepts in a statement as much as the statement itself. You now have to ask, what does dividend yield mean? How does one contextualize it? Because there's a dividend they pay, let's say that's consistent, 19 cents a share, and then you have a share price. And then you do the math, you divide, and then that's the dividend yield. But one is giving you the annual dividend yield, the bottom image, and then the top image is giving you the trailing 12 months dividend yield. But the problem with that is that they just reinstated the dividend yield, I believe, in the beginning of Q2, end of Q1. So it's not even a year old, which that might explain why it's a lower percentage. But then you have to ask, when you look at the dividend yield of something, are they telling you what the dividend yield is as of today, or are they giving you some aggregated average of dividend yield in a prorated form as opposed to annualized? Yet again, if you don't know to ask these questions, then you're going to come up with a lot of information. And this might be quite problematic if you decide to get into stock investing and you decide to be a dividend investor. Like, good luck with that. You're going to get all kinds of information. I constantly see, I'm trying not to give any websites out specifically, or platforms, I'm not trying to say any names, and on a lot of the information they provide you, it seems to me to be updated daily. And yet, some of the information isn't updated daily. And I've seen companies cut their dividend, and then that doesn't get into the numbers. Like, it gets into the numbers on one page, like maybe you look at supplemental information or valuation and it gives you a dividend, and then you go to dividend summary, which is a different section of the site, and then that'll give you a different dividend yield that does or doesn't take into consideration the recent rise or cut in dividend. So yet again, lack of continuity and consistency within a site itself. Now, I remember this day very clearly. I was listening to a YouTube video and talking about SoFi, and by the way, we're getting into the words profitability. We've gone from PE ratio and frustrations caused by that. Now, dividend yields, frustrations caused by that. And then the good old word profitable and earnings. Remember, earnings per share means net income per share. And then you could say per share of what? Diluted or not. But I was listening to this YouTube video, and he said SoFi, I should have put parentheses here, SoFi had technically already broken into profitability. ... They had already reached profitability in 2021. I was driving my vehicle at the time, and I was in a parking lot, and I immediately paused the video because I was like, that's complete BS. So I was like, what is this person talking about? And since I know it's a YouTube video, I presume they were probably showing a picture. And this is the picture they show. Annual adjusted EBITDA. So annual adjusted EBITDA is the same? See, people want to treat it like it's the same because that's why this individual used the word profitability. How would you like your paycheck and the money you make to be one and the same as annual adjusted EBITDA? How would you like an adjusted EBITDA take-home pay as opposed to net profit? You would very quickly find out that they're not often remotely even one and the same. Net income and adjusted EBITDA are not the same, and profitability is not the same. But just wait a moment. The difference between profitability and profit. Key takeaways. Profitability and profit are metrics that are used to analyze the financial success of a company. Profitability refers to the extent to which a company earns a profit. Companies can determine profitability through a number of factors, such as expenses, demand, productivity, and competition. Profitability is commonly expressed as a ratio, such as a gross profit margin, net profit margin, operating margin, or EBITDA. While profitability is a concept, profit is an absolute amount, which means it is the total amount of income or revenue earned above any costs or expenses, which is to say that it's a level of analysis problem. On what level of analysis are you profitable? Because if you go down an income statement, you'll see gross profit, then you'll see operating profit, and then you'll have net income profit. And so when someone says we're profitable, you then have to question the concept in a statement as much as the statement itself. What do they mean by profitable? What do they mean by profit? Yeah, we're profitable insofar as you don't include real expenses in the business that must be paid in order to legally operate. So let's move on past that. In my investigations of the St. Joe Company, which is, well, if you don't know what it is, then it doesn't matter. The point here is that I wanted to see, okay, so they operate in part in Walton County, Florida. I wanted to see how much Walton County, Florida was growing in population size or shrinking in population size. I wanted to see the development of the population and the trend. So now, by the way, I only have 2 charts here. I found multiple sources with different information, and most of them undershot what I would call the correct source, which I did not put in here either, which is Fred, and FRED. And this shows in 2021, the population growth rate was 2.69%. But then this chart, which I want to say I found, I don't know, Walton County Commission side or something like that. And it said that the growth rate in 2021 was 5.6%. But you can't trust people to grade their own homework. So that's when I went to Fred and did the math. It doesn't tell you the percentage change. Maybe it does, but I didn't check that. I saw the population in 2020. I saw the population in 2021. I did the math, and it aligned with this chart. So that's quite the disparity and underestimation of the growth. So then you have to ask, where did they source their information? That would be the concept in the statement as much as the statement itself. The statement is 2.69%. The concept is, how did they get to 2.69%? What did they factor in and not factor in? So that's just further frustrations when trying to put together a thesis and understand something better. This is why you normally have to cross-verify things anytime, and this is where confirmation bias is so diddly because of all the misinformation out there. Like, it's very easy to confirm or disconfirm a belief. Okay, on to the next topic. All-in sustaining costs for any mining and resource investors out there. I'd like to make a whole video on all-in sustaining cost. Maybe I will one day. So normally, managers, directors, CFOs, CEOs, whoever, they're always trying to frame things, framing effect, in a flattering light. And so they might reference cash costs or all-in sustaining costs. But why not all-in costs? Well, because it's more expensive and less flattering, even though that's what's necessary to run the business and to maintain the business in its current condition, defined by cash flows and net income and profits and margins. So this shows the disparity between cash costs and all-in sustaining costs. And then you have to yet again define, what do these things mean? And this is an interesting chart because you have to say all-in sustaining cost. And then you have to ask the question, you have to beg the question, what does sustaining mean? So all-in costs are things that aren't factored in all-in sustaining costs. So then you have to say, what is the converse or inverse or the difference between all-in costs and all-in sustaining costs? Like, does all-in costs not include sustaining costs? Well, it does. So why, like, and what does one mean by the word all? Like, you really should think about that. Just same with profit. All. On what level of analysis? All we need to operate this business is money for the costs of goods sold. Well, what about SG&A? What about interest? What about taxes? No, no, no. All we need is the cost. Like, it's very interesting framing. Community costs not related to current operations. Permitting costs not related to current operations. Reclamation and remediation not related to current operations. Yet again, you have to ask, what are current operations? None of this is self-evident. I see this all the time in human conversation, just on basic normal day-to-day conversations. People presuppose in a false way quite frequently what people actually mean by things. Like, I mean, a very simple example is someone says, I love you to someone. Well, what do they mean by love? What is the behavioral manifestation of love? How are they going to conduct themselves in accordance to this allegation of them loving you? And then why do they so radically change? I.e., why do 50% of divorces end? Because you could say 100% of those marriages began with both parties loving each other, and then it ends with that eroding and disappearing. So then you could say, just because you love me now, how sustainable is that? And yet again, define sustainable. That's predicated on a lot of things. But you get my point, hopefully. It's like you really have to wonder what people mean when they say things. People say, my favorite example of this is the story that goes, it's a very short story, along the lines of this couple sits down for a piano recital, and then afterwards they go up to the pianist and say, one of the people say, wow, that was the most beautiful thing I've ever heard. I would love to play like that. I want to play like that. What is it that you had to do to make that happen? And the pianist says, 5 hours a day for 10 years. And then sure enough, that individual asking the questions who wanted to play that way then never dedicates themselves in accordance with their alleged goal that they want. It's like, I thought you wanted to be a pianist of that caliber. It's like, well, you're not willing to dedicate 5 hours a day for 10 years. So you then really have to ask, what do you mean by want? A lot of people say they want to be rich or they want to be healthy, but then they waste hours a day and do the bare minimum and the status quo, and they have tons of coping fallacy into all of it, and they don't exercise, they don't eat healthy, and then they excuse their behavior through some sort of false attribution error and fundamental attribution error, and just on and on it goes. So you really have to question what people mean when they say words, basic words that you take for granted. So I really like this word of sustaining because, back on topic here, if I have an oil well and I'm depleting it, it's a depleting asset, and I say every month I make $100, trying to keep the numbers simple here, I make $100 from that well. What is necessary to sustain that production or sustain that income? Because at some point you're going to have to spend money on exploration to find a new well, and then you're going to have to drill that well and spend money on drilling that well. So in order to sustain that level of production, let's call it 100, 2 barrels a month for $100, $50 a barrel, just go with me here. In order to sustain that production level and that revenue, you're going to have to spend this other money. But that other money isn't factored in oftentimes to all-in sustaining costs. Because are we talking about sustaining that well, or are we talking about sustaining that level of production and revenue? And then you look at, Google definition of sustaining CapEx. Means expenditures, including expenditures for the addition or improvement to or the replacement of the capital assets owned by the group company. That might be replacing the pump on the well. And then maintaining the operating capacity, capital asset base or operating income, or maintain or extend the existing useful life of the capital assets. So there we go, maintain the operating capacity. How many barrels of oil we're getting a month. And the operating income, i.e. the money you make off of those barrels. So all-in sustaining cost is not all in, and it's a limited, bastardized, perverted, co-opted, manipulated version of sustaining. Now, this is a person, I believe the Substack is free, so go help yourself. Ben Kramer Miller has an article about assessing equivalency reporting in drill hole data. So I'll just, this tiny little bit. If you're reading exploration company press releases featuring drill results, you have likely come across equivalency reporting. For instance, a company's exploring a copper-gold porphyry will oftentimes express the value of the gold in copper terms and add that to the actual copper grade and report this as a copper equivalent grade. Now, if you don't see why that might be problematic, then, well, I don't know what to tell you, except read the report. How about that? Another issue, we're moving on again. Another issue is as a new timer who becomes discouraged by all this information. And, I meant to say this at the beginning. So I don't have a formal education in finance. I'm historically, with most things I do, self-taught. Now, yet again, the word self-taught needs explanation and contextualization because, say, I don't have formal training in sheetrock repair, but I might not call someone who does have formal training, apprenticeship, prior knowledge of sheetrock repair. So what might I do? I might YouTube a bunch of videos and cross-compare, see what they do, what they don't do, what they criticize, what they don't criticize, what they endorse, so on and so forth. And then I get the gist of it, and then I implement it in a non-professional, sloppy manner at first, but then over time, practice, experience, further knowledge, you become better informed and educated, and you synthesize that and integrate it into yourself, and you become a more comprehensive human being, just like I've done with investing, let's say. And it doesn't mean you do it right, it just means you do it less worse, perhaps, but that's progress, I suppose, even though the end result does matter, and effort does need to translate to results at some point. But another frustration is buying things that you don't realize require extra documentation when it comes to tax time or for any other reason, such as passive foreign investment companies. And that would include, if I'm not mistaken, the Sprout Physical Uranium Trust, which I own, as well as, let's just say, UROY, that's ticker symbol, I believe. That'd be Uranium Royalty Corp, which is one of a kind that I know of, which is, well, a uranium royalty company. And there's, go Google this. I'm not going to belabor this point. Maybe you can read this. That's one reason why I do this video this way, is so people... One of the two irritating things in today's day and age in technology is people putting stuff on screens that you can't read. Like, thanks for citing it and showing us a picture to make it look more like an appeal to authority and that you're sourcing your information, but I can't read it, and that's kind of frustrating. And then the second thing that really bothers me is audio. Like, it's 2023, people, and this is past the point of the COVID lockdowns and stuff where so many people were working from home and it was excusable to not have good audio and supplemental resources for creating better audio. Like right now I'm using a plug-in microphone. All my videos have. I recorded my very first video and the audio was audible, but it was not nearly as clear as I wanted it to be. So I bought like a $15 audio piece. I've thought about buying something better, but I haven't, and this seems good enough, so is what it is. And for now, and Like, it's inexcusable. The audio is inexcusable. And I can't remember. I don't know why I went on that tangent. Anyway, being able to read what's on the screen. So you can read this. I would recommend you go look it up because there's some oil royalty companies, Canadian listed, I'd like to be involved in. That's primarily why I'd like to be involved in. But then there's a dollar point where it will cost you more in paying a tax professional and someone to do the paperwork than otherwise would be. You have that with a lot of the, like, WEAT, WEAT, USO, and things like that. I can't remember the filing, but it's not a 1099. You have to file something else. I'm drawing a blank here, so excuse me. And if you go to like H&R Block, they charge you an extra $30. Well, one of the points of this YouTube channel is to show how little differences make a big difference and how to start off small and grow a portfolio and things to do and things not to do. And that's one of those things. If you spend $50 on USO, you make 20%, you make $10. You're like, okay, well, that's a good annualized return. Made $10. But then you go to H&R Block, and then they have to file separately on a different piece of documentation, and they charge you $30 for it. So in absolute returns, which this channel is concerned about, and you should be too on some level, you've now lost, by putting on that trade, you lost $20. You made $10, you had to pay someone an extra $30. A K1, is that the form? That sounds right. A 10K, yeah, something like that. And like you end up losing $20. So now you have to put on a large enough position. Another thing, which is why you don't see me with any over-the-counter stocks, since I'm on this point, is because it's $8 to get in and $8 to get out. So you spend $50, let's say, on a position. Well, you're ultimately going to pay $16 for that position, which means that stock needs to go up 32% before you break even. But then you have to pay taxes on the profits. So now you need 40, 50%, which is why you need to put a larger sum up in those situations. And well, these are things to know. And I'm not seeing a lot of channels who discuss matters like what I'm discussing here today. And the inconsistency when you go to check your homework against other people, or just blind spots that you don't know any better. You don't know what you don't know. But this is another one of those things. Here we go. The thing that prompted this piece today. Return on equity. Return on equity is a measure of financial performance calculated by dividing net income by shareholders' equity, because shareholders' equity is equal to a company's assets minus its debt. Okay, so what I want to emphasize here is they said that shareholders' equity is calculated by a company's assets minus its debt. Remember the word debt. Then in the same article, they say that shareholders' equity is equal to assets minus liabilities. But hold up. I thought shareholders' equity is equal to a company's assets minus its debt. Well, you could call this a lot of things. False syllogism, association fallacy, denying the antecedent, perhaps. I'm not sure if that fits in here, but that's a fun one to look up. Like A equals B, but B doesn't equal A, conflating categories, things like that. Good old basic logical fallacies from a very reputable website. And people, this is the problem with using words interchangeably and bastardizing and desensitizing yourself to your speech, as I would say the vast majority of the public does on everyday living, let alone investing, which is one reason why most people don't do well with investing, is because they're so complacent and complicit in corrupting and pathologizing their speech. well beyond what I'm going to discuss here today, that they're doomed from the get-go. So, liabilities versus debt. A liability is a broader term that represents any financial obligation or upcoming duty a company has to pay. Okay, debt, on the other hand, is a subset of liabilities. You can read this whole thing if you want to, Google it, find out the difference. So liabilities include other things that debt doesn't. Debt is limited in its overarching application, while liability is the umbrella term, and liabilities can include accounts payable, salaries payable, interest payable, taxes payable, and deferred revenue. None of those things fall in debt. So then you have to ask yourself, like, I find this so infuriating and aggravating. This is what prompted the whole thing, and this is actually what prompted me to quit investing the first time. Was actually, in large part, this website was due to lack of articulation and clarity and consistency. Because actually on many of their other web pages that include shareholder equity, they actually say more often than not that shareholder equity is total assets minus total liabilities. Okay, so more often than not they're correct. But yet again, if you don't go read all those other articles and you just read a few and you're like, what the heck? And we're going to get into another one when it comes to return on assets. So, but they do this with quite a few things. And like you could say, another example is net income on this site. And then they say it's all costs. Well, then you have to ask the question, what is a cost to a company? And what you'll find out is, now I could be mistaken here, so I don't want to be a propagator of misinformation, but I believe in net income, the dividends paid out to preferred holders is deducted and therefore is included in net income, while dividends to common shareholders, not preferred shareholders, is not included in net income. So net income is calculated and then dividends are paid out from that. But is dividends not a cost to a company? And yet again, I'm not saying it is or isn't, but what I'm saying is you should be asking these questions and thinking along these lines and really asking yourself, what is a cost? So I then go Google. So you read something. You go to a website, you read something, and then it has contradictive information or inconsistent information. So you want to find clarity. Okay, so then you go to Google, and then you ask Google, for instance, is there more to liabilities than just debt? Now, this is what I Googled on my computer. Now, notice the sites that come up first. You have Quora is the first site, and then Investopedia is the second site. Now, if you notice and are paying attention and can read it, I misspelled, I spelled then, T-H-E-N. And then the second time around, I spelled then, T-H-A-N. Now, you would think that shouldn't make a difference. I don't know why you would think that, but that seems to be understandable. Well, sure enough, Indeed comes up first. So Quora came up first the first time, and then Indeed came up first this time. Well, then on my phone, I asked the same question. I cannot remember which way I spelled then. And then a third option comes up first from Superfast CPA. So, depending upon your misspelling and what device you search something on, I'm actually with like a VPN to really be able to explore things and know things, because I think my eyes would really be opened up. But that's a side note. So depending upon where you then go to search to get clarification and how you type it and whether you spell then T-H-E-N or T-H-A-N, you get different results. And most people are lazy and intellectually lethargic and personally incredulous and look for confirming information and so on and so forth, and all these biases stack up against them. What I'm getting at here is that they go Google it, they click on the first link, they read that first link, and then they're done. And either that confirms or disconfirms. But that's a very dangerous game to play. So then you have to go and read 3 articles and compare them. Because who's to say that the order in which you receive information is reflective of the accuracy of that information? For instance, you went to the very first site that then has different information in the same article. Okay, so that's invalid. So you go to the second source. Who's to say that's not invalid as well? And then you could ask the base rate of how much of the information out there is actually valid. Okay, so return on equity is net income. I'm not going to belabor this too much. Return on equity is net income divided by average shareholders' equity. And shareholder equity equals total assets minus total liabilities. Now you can say, oh my gosh, well, think of it like this. You might recognize this equation as a homeowner. To keep numbers simple, you want a $100,000 house. You want to put 20% down so that way you don't have to pay that premium insurance. If you don't know what I'm talking about, don't worry about it. You buy there's a $100,000 house you want, you have $20,000 to put down. So the house, total assets, is $100,000. Total liabilities is $80,000 because you have $20,000, you borrow $80,000. So your shareholder equity is $20,000, and that equals total assets minus total liabilities because the house is $100,000, the liabilities, what you borrowed, is $80,000. So your equity is $20,000. So that all makes sense. Now, return on assets. This one irritated me much more. The other one you could just say was a typo, oops, whatever. But this really triggered me. Return on assets and return on assets versus return on equity. So it says, but one of the key differences between the two is how they each treat a company's debt. Return on asset factors in how leveraged a company is or how much debt it carries. After all, its total assets include any capital it borrows to run its operations. Now let's stop there. What are they talking about? What they're talking about is assets equal liabilities plus shareholder equity. I'm going to give you an example in a few slides in regards to Tidewater. So don't worry, we'll do an example. And I really struggled incorporating this return on assets component in this slide, and it's going to be the end of my presentation because I figured it's the hardest for me to articulate and the most difficult to understand, both due to my lack of articulation, but the little mental gymnastics that go on here. Okay, so back to this. Return on assets accounts for a company's debt and return on equity does not. Okay, remember that. Return on assets accounts for a company's debt and return on equity does not. So I Googled, something along the lines of, does return on assets include debt? Now this other website says, it is important to note that return on assets is a measure of profitability and does not take into account the company's debt or equity. So it's like, oh my God. So the first website says return on assets does take into account the company's debt. And then the second website disconfirms that and says it does not take into account the company's debt. So then, I can't remember all what I Googled, but I Googled the same question, but on my phone, and other stuff pops up, sure enough. So keep this in mind, people. It's worth Googling something on your computer and then Googling it on your phone. This goes on to say, the difference between return on assets, ROA, and return on equity, ROE, is that the ROA metric does not factor in debt in a company's capital structure. And then the other site says return on assets factors in how leveraged a company is or how much debt it carries. So even this pop-up, this little annotation, contradicts itself. So I'm like really? Really? So I go on poe.com, or I guess that's how you pronounce it, POE.com. I'm not quite sure what it is. It's something like it uses Chat GPT, but it's not Chat GPT. I'm not really sure what it is, to be honest with you, except it's like you just type in POE.com on your phone, and then it allows you to ask questions as opposed to Chat GPT. It seems you have to give them your email and this and that, and I'm not interested in that, so there's a convenience factor. But now this is what's interesting. And let me give you the gist here. Poe.com says, yes, return on equity considers debt, and yes, return on assets considers debt. That's the gist of the story, but let me read it. Yes, return on equity does consider debt. Return on equity is a financial ratio that measures the profitability of a company by comparing its net income to its shareholders' equity. Shareholders' equity represents the portion of a company's asset that is owned by its shareholders. The formula for calculating return on equity is net income divided by shareholders' equity. Debt is not directly included in the numerator of the return on equity formula, net income, but it can indirectly affect the calculation through its impact on net income. Interest expense, which is a cost associated with debt, is deducted from the net income to arrive at the final figure used in the return on equity calculation. Well, that's interesting. That's not the angle I was taking, so I actually found that to be interesting. I did not think of that. And then it says, yes, return on assets does consider debt. Return on assets is a final ratio that measures the profitability of a company by comparing its net income to its total assets. It provides insight into how efficiently a company is utilizing its assets to generate profits. The formula for calculating return on assets is net income divided by total assets. Debt is not directly included in the numerator of the return on asset formula, net income, but it can indirectly affect the calculation through its impact on net income. Interest expense, which is a cost associated with debt, is deducted from the net income to arrive at the final figure used in the ROA calculation. Yet again, didn't think of that angle. So this is what I typed out. Hopefully it doesn't confuse you. I can't blame you if it does. So I wanted to give an example. Now, maybe I'm wrong here and this is misinformation. You shouldn't necessarily trust me. What's the saying? Caveat emptor? What's the saying? Trust but verify? What's the saying? Do your own due diligence? It applies to me just as much as anyone else. So on to the example. You buy a $200,000 house. You put 20% down. Your equity is $40,000. Okay, you buy a $200,000 house, you put 20% down, 20% of $200,000 is $40,000. That's your equity. If the house now appreciates to $240,000 and you sell it, then the following occurs. Your return on equity is 100%. Your equity was $40,000. You sold the house for a $40,000 profit. Now, this excludes taxes, closing fees, blah, blah, blah. This is a very basic example, okay? So you put in $40,000. You got $40,000. You made 100% on your money. The return on asset, now notice when I said that, implicit in there was how much debt I had. It was integrally associated. Okay, return on assets, 20%. Why? Because $40,000 on $200,000 is 20%. So the return on asset is 20%. The return on equity is 100%. Now, you could do the math and figure out how much equity I had in it, like if I didn't tell you how much I put down, if I told you the house was $200,000, it became $240,000, I made 100% of my equity, you could do the math and figure out how much equity I had and therefore how much I made on the equity by factoring in debt and equity. And then you could do the same for the return on assets. It was $200,000, it became $240,000, that asset returned 20%. You have no idea how much equity financed the deal, and you have no idea how much debt financed the deal. All you know is the asset returned 20%. Okay. So I'm just going to read this. Return on asset doesn't factor in who owns what. Only once it's time to divvy up the money does it matter. Now, how much of that is yours or the bank's is unknown until you separate how much equity you have in it. That's how you get return on equity. The less equity you have, the higher return on equity, but it makes no impact to return on assets. What do I mean by that? Let's say that $200,000 house, I did not write this down, I'm going off script here for a moment. Say that same $200,000 house appreciates to $240,000. But I only put $20,000 down. Okay? That's 10% equity. Then the house goes to $240,000. Well, my return on equity, oh man, I already forgot what I said. This is why you don't go off script, people. So I put $20,000 down on a $200,000 house. That means I have 10% equity. Okay? So when I sell it for $240,000, I make $40,000. So that's a 200% return on equity. So that's why the higher or the less equity you have, so I went from 20% down to 10% down. And as a consequence, I went from making 100% return on equity to making a 200% return on equity, because one example, I put less money down than the other. So when you make $40,000, just imagine if I put $1 down, I'd make, I don't know, 40,000%, or I don't know, 400, whatever the number is. So now let's go with the example. The asset is the same price. The asset is not a function of how much debt is financing it. The asset is a $200,000 asset. So regardless of how much equity I have or how much debt I have, the return on the asset is going to be the same, $40,000, i.e. 20%. So back to reading. Yes, technically an asset can be broken down into the subcomponents of liabilities plus shareholder equity, but that mix doesn't affect ROA. So although ROA and liabilities are integrally associated as a consequence of not being able to attain that asset if it weren't for the debt, but the same could be said for equity then. If it weren't for the debt, you couldn't have any equity as a consequence of not being able to afford the asset in the first place. Neither of these ratios explicitly tell you anything about the debt or even if there was debt. Return on equity and return on assets could be the same. I.e., if I paid $200,000 of cash for the $200,000 house, I have 100% equity, okay? And then if the house appreciates from $200,000 to $240,000, I make $40,000, which means I make 20%. So then my return on equity would be 20% and my return on asset would be 20%. What I'm getting at here is that as far as I'm concerned, as far as I can discern things, based upon the years of confidence I've developed, confidence doesn't equal right, remember that. Return on assets and return on equity are both a function, are both a function of debt on some level of analysis. Now, the problem is that assets are technically liabilities plus shareholder equity. Okay, but if you go and look up shareholder equity, it doesn't necessarily calculate. Shareholder equity doesn't, I guess, theoretically need to know the debt to know how much equity you have, but you do need to know how much liabilities you have to have. It's a non-starter to me, to be quite honest with you, and it just all rubs me the wrong way. Both return on equity and return on assets have a component of debt involved the majority of the time. But earlier, let's go back to it. It says that what does it say? That return on equity does not factor in liabilities. It's like, I mean, on some level of analysis, technically that's true, but you could say the inverse or the converse as well in regards to equity. It's stupid and it's misleading and it's confusing, and I've probably confused you. And I just wish that you go about your own and maybe rewatch this section, read it, don't listen to me, and try to make sense of it yourself. On a final note with this, before we get to the Tidewater example, the very site itself says the amount of money that equity is defined by them, the amount of money that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debt was paid off in the case of liquidation. So equity is the consequence of debt being paid off. Like, I don't know, and maybe I'm missing something. I suspect I am. Or, well, I'll just leave it at that. So Tidewater, hopefully you can see this. Now let's not forget, assets equals liabilities plus shareholder equity. The simplest way that I know how to highlight this to you is if you see, hopefully you can read this, total assets, I'm gonna make round numbers here. Total assets is 1,297,000. And then total equity is 865,990. Okay? So that means what? Assets, let's not forget, assets equal liabilities plus shareholder equity. And this is what really irritates me about a lot of companies' reportings. They'll tell you the total assets, but they won't oftentimes tell you the total liabilities. You have to finagle the numbers to figure it out for yourself, or subscribe to some site that offers it up to you. But the problem with those sites, oh man, I meant to include this. I'm going to say this now. I'm sorry to sidetrack and add in further confusion here, but just pause for the cause. When I was looking up, I believe it was SurgePay, I was looking up the quarterly cash flows, but I was trying to figure out the cash flow multiple, trailing 12 months cash flow multiple, and to see if cash flows were growing, shrinking, how they were doing. I look at the 10Q. It says cash flows were positive. Well, then I go to this unnamed site, and it says cash flow negative. Now, I still don't know why, because other quarterly reportings that it reported were in line. So it's only this one instance within that it failed to accurately sync up into cash flow. But that if you trust this one site a little too much, then you might get the wrong impression if you don't read the 10Q. Go directly to the source, cut out the middleman. Use it to cross-verify and to confirm or disconfirm, as I've pointed out here multiple times already. So I meant to put that in, but that's just another frustration. Because now when I suspect, I didn't confirm this, but now when that site says it's trading, when it does the valuation math for you, it'll tell you its cash flow multiple that will be different in reality. Because if it's hindering and If it's misrepresenting what the cash flows are, then the cash flow multiple will be different. So now it will look like it's at a higher cash flow multiple than what it is as a consequence of reporting a negative cash flow quarter, when in fact, according to the 10Q, it did not have a negative cash flow quarter. So you have to remember that. Back to Tidewater. So how does liabilities plus shareholder equity actually, what does it actually look like? Okay. So normally when you look at a balance sheet, it'll be assets, then it'll be liabilities, and then it'll talk about shareholder equity. That's normally the flow of a balance sheet. So you can also calculate, because how do you figure out the total liabilities? So what you have to do is assets. So if assets equal liabilities plus shareholder equity, then what's also true is assets minus shareholder equity equals liabilities. That's how you figure out what the liabilities are. So they tell you that the total shareholder equity is $865,990. Okay, they tell you that total assets are $1,297,656. So you deduct total equity minus total assets, and that's total liabilities. Well, there's no total liability segment to verify that with in regards to the balance sheet. So then you have to start looking for numbers that add up to equal the difference between, or you have to start looking for numbers and plug and play that gives you that $431,666 disparity once you subtract out equity from assets. And then here's the number. Total current liabilities. They'll oftentimes give you that. And then you have to say long-term debt. That would fall into total liabilities and then other liabilities. So once you add up total current liabilities plus long-term debt plus other liabilities, normally they'll be in succinct order, then you find out that's $431,666. So sure enough, shareholder equity plus liabilities does equal assets, because it's kind of messed up, because you buy an asset for $100 million and you finance half of it. That means you have $50 million liability, and on the balance sheet you have a $100 million asset. So you have a $100 million asset, $50 million liability, because you paid half of it. So you have 50% equity in that and 50% debt in that asset. So a better way, and I wish people would articulate it this way, shareholder equity is best maybe defined, not best, is better defined as assets that aren't debt burdened. So shareholder equity is not all the assets. It's merely the assets that are outright owned without any debt. And then you can think of liabilities as equaling all the financing of the assets. That's the remaining assets. So shareholder equity is only some of the assets. Those some assets are the ones paid off in full. And then liabilities you can think of as assets that have debt on them. So assets with debt on them plus assets without debt on them equals total assets. That's how I think about it. And instead of spending an entire day ripping your hair out, trying to read all kinds of things, like, it'd be nice if people just worded stuff that way. It really would be. Assets with debt plus assets without debt equals all assets. And assets without debts is synonymous with shareholder equity. Now, you might say and ask, what happens if liabilities are more than assets? Well, then you have negative equity is the answer. Just like if you have negative current liabilities, I'm sorry, if you have more current liabilities than you have current assets, then that would be called, depending upon the language, insolvent. you have negative working capital. Now, I'm not going to go down that road of what's considered current assets and current liabilities, but if you see a company with more current liabilities than current assets, you're like, well, are they going to dilute shareholders by selling shares to raise capital to pay off those short-term debts because they owe more than they have in the next 12 months? So cash equivalents, accounts receivable, as opposed to interest payments, loans coming due, accounts payable, back taxes, interest, things like that. It needs to balance out. So it's nice to know what total liabilities are, because they'll just tell you, I can't believe I didn't take a screenshot of it. What they do is they say something like total liabilities plus shareholder equity equals, and they give you a number. It's like, okay, well then you have to back out and do the math to find out total liabilities, because then you might find out that total liabilities exceed total assets. But you have to do the math. Now you would think, I thought we were friends. But, don't they have your best interests in mind? You putting up the capital and investment? Wouldn't they just tell you that? Well, you're deluded if you think that's the truth. Remember, these same people are telling you EBITDA. They're telling you adjusted operating profit. They're telling you community adjusted EBITDA. They're telling you all-in sustaining costs when they don't mean... It's like, yes, it's all-in sustaining costs if what you mean by all-in sustaining costs is neither all-in nor sustaining. Then yes, it is all-in sustaining costs. So I believe that's the end of this segment. On to the portfolio review. Okay, so for those who might not know, the market's been going down a good deal. And, I'm not really even panicky about the whole thing because, it's a very... To me, at least, it's a nice gradual sell-off. I mean, I don't know. I think I'm down like 8% on a month, and the month's about over. The only thing, if it keeps falling here rather shortly, I will be deploying all my capital, and then henceforth deploying all capital every week for my cash contributions, weekly cash contributions, until a point gets hit that I stop, which is to say that in the short term, I'm actually kind of looking forward to the dip. Wish I had more cash, but I'm going to get a little bit more cash. And I'm going to tell you why. YPF, that's the Argentina play. I'm now down 23%. That's no good. I would be down less, but on more money if I was able to buy the dip but due to cash accounting rules and not making trading infractions, I couldn't buy the dip. So, but that doesn't matter. Fundamentally, I'm down 22.5%. Very, very, very likely I'm going to be out of that position at the beginning of next week. I was going to sell on Friday. I didn't. More as a consequence of me not having access to the internet at the time than anything. And that didn't bother me too much, being that it's a small percentage of my portfolio. So why am I selling? Well, it was a trade on Milei or Bullrich becoming the president. And my goodness, the Argentines seemingly have not learned their lesson, and they're, what's the phrase? Something along the lines of wanting more abuse, because I believe 38% voted for the Peronists. Now, here's the problem. You're coming across bad times, and then some radical person like Milei comes along. You're like, whoa, I'm not this guy's a little crazy, okay? But normally when you're in desperate times call for desperate situations call for desperate measures. The problem is it's not that cut and dry. It's not that binary. It's like, okay, how desperate are we, and how desperate of measures are we needing? Okay, it's not just desperate equals desperate. That's not how it works. So I thought, see, you could say that Bullrich isn't desperate behavior enough, and then Milei is too desperate. So then people do the same old because they want predictability and security. However that's defined, that's a level of analysis. Remember, history has demonstrated to us time and time again that people rather vote for literal dictators than take a bet on something different, because at least they're accustomed. That's why people, in part, stay in abusive relationships. I mean, there's a lot of other factors like insecurity and they don't know where to go and this and that, but the same holds true for voting for a dictator. It's like, if I don't vote for the dictator, who will I vote for and what will they bring, and all the insecurity, and you're like, well, I'm insecure both in my ability to secure resources, and it's probably just I'm doing well enough under the dictator, so I better vote for the dictator. And like, it's a serious issue. So you could say they're obviously not desperate enough fundamentally, so it's unfortunate. I can't think of the word I'm looking for here, but the fact of the matter is, I believe the Peronists got 38% of the vote. Milei got 30%, I believe. Bullrich got 24%. So you could say that the Bullrich votes will... See, what's interesting is not so much that Milei got 30, but that Bullrich got 24. You think some of those Peronists might have slid over, and perhaps they did, to the Bullrich camp. And I'm kind of underwhelmed by it all. And sure, maybe the Bullrich supporters will back Milei and then he'll win. But then it's like, it is a democracy, people. So now he's just going to, be gridlock in the government and not be able to make the things happen that are necessary to happen because the voters voted the way they did. So it's going to make... you vote for Milei as a consequence of the behavioral manifestations that he'll implement. But the problem is that only if a minority of the majority votes for Milei, then that means that there's still a large swath of people who's against him and pushback, which is an overwhelming win. Because then that shows overwhelming support, which means overwhelming compromise, because the voters dictate what the politicians do, because the politicians, if they don't, will not get reelected, and their own perverse self-interest makes it where they're non-playable characters. They're a reflection of the voters for the most part. And therefore, as a consequence, like when you see a stupid politician, remember, they're a stupid politician acting a fool, being difficult, being uncooperative, because there's a sub-constituent of voters, citizens, neighbors, might be your family, your friends, that are fools, that are stupid, that are uncompromising, that are ignorant. And therefore, it manifests in the politician because the politician reflects the voters. So you want the overwhelming vote for Milei or Bullrich or someone because, that signifies an overwhelming support by the voters, and therefore the politicians will fall in line with the voters out of their own incentive structures. And then they'll jump on the bandwagon and herding mentality, and they'll just false enforcement and pluralistic ignorance and all these things compile. And even though they might not believe in it, they'll pass Milei stuff because that's what the majority wants, and they just want to keep their jobs at the end of the day. They don't care. So, it isn't that they don't care, it's that they care about other things more. It's a value hierarchy of prioritization. So they'll pass bills that they don't believe. I mean, American voters do it. The Republicans. I mean, I suspect that my channel is disproportionately Republicans or libertarians, and like Republicans vote for Democratic stuff. I mean, it's pork barreling. It's you get a 15,000 page thing passed, and like there's a bunch of crap for. Well, I won't say anything specifically, but a bunch of crap that gets supported for the Democrats, and Republicans voted for it. They passed the bill. Why? It's you pass my stuff, I'll pass your stuff. So they vote for stupid stuff. Why? Because it gets their stuff passed. Why does that matter? Because then they can go back to the people that voted for them and say, look, we got our stuff passed. Voters, vote. Most people, I don't want to be too disparaging here, but the average person is average. And if you understand what that means, you should be scared. And so the average person isn't going to be like, yeah, but you voted for all that other stuff too. And that's kind of like contradictive towards the stuff that we wanted. And then it's like, at what cost? And is this a net benefit? They don't do that. You know how many times I've ever heard any human ever say net benefit? I don't know, a handful of times. They say, this is good. They don't factor in all the ways it's bad and that's a net negative. People don't do that. So anyway, Milei didn't get the overwhelming support, and that's kind of necessary. YPF needs to be needs not to have price locks, needs to be able to export. It needs to do things to be able to exploit the Vaca Muerta, the second largest shale field in the world, to its benefit, and to do well, to be able to get dollars, to not have a currency that's chronically collapsing, like to not be forced to sell most of its product in country for a depreciating currency, and yet have to make a lot of its CapEx expenditures in dollar terms. Like, it needs those things to do well, to really positively inflect, and how much of that is going to happen if there's not overwhelming support? I don't know. So, not really interested in finding out, even though it's a smaller position than what it was, because it's down 22%. So, anyway, probably raise capital there and deploy it elsewhere in the coming weeks. I got a lot, as you can see by all these E's. We have a lot of earnings reports coming up, and if you've noticed in the market, a lot of earnings reports are getting slammed, and the charts aren't looking the most bullish. But like I said, if things keep going down, soon enough I'll be deploying all my capital readily, and we'll see how that plays out in the coming quarters. I believe with that said, I am done for the day. Thank you for watching, and until next time.